Hi, I'm Mike Coe with my friend and colleague Carter Braxton Worth, bringing you our Web Extra while CNBC continues coverage of the Beijing Winter Olympics. The market began the day marginally higher but finished sharply lower, with the S&P falling nearly 2%. 10-year rates also retreated quite sharply, falling to just over 1.91%. That rate decline, not because the market has somehow forgotten inflation, but rather a more imminent concern has shifted to the foreground, the risk that Russia invades Ukraine, which some experts suggest could happen, and if it does, possibly in days to weeks. Given another day of sharp moves in rates, let's examine the implications for equities a bit more closely. Carter, the VIX is near 30, which suggests significant volatility. What levels are actually in play?
Well, that's right. We've got a lot of things on the board here. Let's look at rates first. And again, how important trendline work is. This is 10-year yield. And what we know is we literally got just above 2, and it struck its head. Now, one could say it's news related because of the risk of Ukraine and a flight to safety and people buying treasuries. But either way, right against that arithmetic line, rates backed away. Now, we do have a log chart next, just to put it in context. Were we simply to go to trend on the log chart, it would suggest 1.75. I'm sorry, 2.75 on the 10-year, and that would be a whole world of hurt for equities. The 5-year setup is the same. If you look at the 5-year yields, there's the arithmetic. We got right to the line and we backed away. On the log, of course, we're nowhere near the trend, but the trend is precise again, and it does imply higher yields over the period ahead, intermediate in any event. But the S&P really took it on the chin. And let's look at, I think, an important chart for the S&P. So this is the entire 2009 to present ascent. And that first line drawn there, that's the internal trend line. Now let's add some lines. If you do a second line, a parallel line, that's mathematically parallel. Now you do a third line, that's the middle of the channel. And this is the story of the equity market as measured by the S&P 500 since the '09 low. So were we simply to sell off to the middle of the channel, and you'll see that here, that implies a 19% sell-off. We know at the worst point, we were down 12 plus a week or so ago. Were we to go to the bottom of the channel, you're talking about something closer to 30. Does that have to happen? Of course not. Is that a reasonable thing to have in one's mind as one proceeds in the weeks, months ahead? Of course.
You know, it's interesting because with the VIX at 30, you know, we should just sort of think about what that means in terms of market implied moves from options. And of course, right now at that heightened level, it is suggesting that a much broader range of future prices is in play for the near term. Equities are not the only area getting a lot of action today, though. So are commodities. We don't discuss commodities that often, particularly the softs, but they deserve some attention. The first of these is wheat. Call options significantly outpaced put options on wheat futures today. The April 8, 20 calls were most active, and there was also above average activity in the wheat ETF, ticker WEAT, where the March 8 calls were most active. Carter, what are you seeing there?
Well, this is the definition of north by northeast. Higher, higher, steadily higher, but never gets frothy, right? No blow off, if we saw in lumber, for instance, recently. And so the only interpretation in principle is stay long, be long. And the arrow there depicts that.
Yeah, it's not the only soft that's seeing this kind of activity. Another agricultural commodity that was trading higher and seeing a lot of call activity was corn. The March 700 calls were the most active, with calls outpacing puts by about 3.5 to 1. And the corn ETF, which shares that name as a ticker, traded 3 times the average call volume and saw opening activity in the way out of the money August 32 calls. Carter, corn closed at about $6.50 a bushel, but hit highs over $7.72 last May. Could it potentially exceed that level in the next 6 months, as some traders seem to be betting?
I would say yes. And we have one chart here that shows a very clear circumstance. A much bigger commodity than wheat, of course, in terms of the total value traded, as well as the size of the crop and the implications globally. But what we know here is that this is a textbook breakout, a strong move, and then it starts to consolidate. It's often called an ascending triangle, where the tops are flat and it keeps bumping up against, and then it blows, it breaks out. And you can see there that the breakout is underway. The implications are higher prices.
Yeah, the commodity virtually all of us see on signs around us every day is oil, or at the very least, oil products like gasoline. Oil rose 4% today. Goldman Sachs made a $100 a barrel call on oil not that long ago. And although sometimes analyst calls like that one ring the bell on local market tops, this time that looks very much in play. The March 95 calls on WTI were most active, trading nearly 20,000 contracts. And remember, in futures land, each contract represents 1,000 barrels, significantly larger than the options contracts we see on equities. And in Brent, it was the April 100 calls that were most active, trading over 10,000 contracts. We also saw unusual call volume in BNO, that's the U.S. Brent Oil Fund ETF, which traded nearly 2,400 Feb 26 calls. Both Brent and WTI are now within spitting distance. Could oil top $100 a barrel in the next 2 to 3 months?
I mean, it's going to get down to one simple thing, whether it's go or not go in terms of invasion of Ukraine. We know that supplies are tight. We know there's post-COVID demand. We know there's outages in Nigeria and Ecuador and all of those things. We know there's backwardization in the market. But it really, to get to 100 plus, should have to have a geopolitical event, in my estimation. But here is a chart of oil, no judgments, no annotations by me. Now, let's look at some lines. If you look at this chart, fascinating. There's no DCF here. There's no enterprise value EBITDA. There's no price to book. Commodities are almost always technically driven, and you can see that oil has gotten right up into the upper band and has basically been bumping at that level. We've backed away quite aggressively, actually dropping as low. We went from 93 to 88 a barrel, but now we're right back at 94, and we close to the penny on that line. Whether it goes through the formation up and out or not is only dependent on, surely, what happens in the Russia-Ukraine standoff.
Yeah, I mean, I think it was only a week ago that you and I were talking about the fact that we thought maybe it was about the right time to fade oil. And we actually did see some people doing that in the integrated oil names and things like that on the option side. The flip side of that same trade, though, was another commodity that I don't think any commodity conversation would be complete without, and that's gold. Gold rose nearly $26 an ounce today. In the futures, puts actually outtraded calls, although we did see some activity in the March 2000 calls. But on the ETF side, the options flow was decidedly bullish. GLD traded nearly 3 times the average call volume, close to 300,000 call contracts in total. The April 177 calls alone traded nearly 19,000 contracts. Translating that to gold prices, that's a bet on prices north of $1,925 an ounce within the next 2 months. Given that gold hit highs over 2,100 an ounce in 2020, Carter, what levels are in play?
And here too, it's a fascinating kind of thing. So that is gold. You can see it, and there's nothing on that chart. Let's put in some lines. Take a look at this. How can it be? This is a great anathema, of course, to the CFA Society or to anyone studying supply and demand and buying by central banks and buying in, let's say, the Indian retail market. It has literally, like a pinball, reacted to those converging lines. And today, we broke out. Is it news related? Surely. But either way, it's an important development. And those are converging trend lines. You have a standoff between bears and bulls, and you now have a move up and out of that formation. Now, not all moves are perfect. Sometimes they fail, but by all accounts, and I wouldn't put that green arrow there for a reason, I think there's higher. I have a second gold chart, and this is also something to consider. Now, an analogy is a weak form of argument. And there, however, are many people making the analogy that this current circumstance is analogous to the 2011-2013 event. And you see how I've drawn the lines there. It does look quite similar. But 2 things I would point out. When we got to the apex of the formation, when we started to break down in 2013, 10-year yields went from 1.5 to 3.1. And I think a lot of thinking is that we're looking at something like that now. But see, I don't think the market can handle that. I don't think the Fed would ever risk that. And I think the message of gold, especially as real rates have been going higher and higher week after week, gold's held firm. It's an important thing. I think you want to be long.
Yeah, I'm kind of inclined to agree with you there. And I think we had an options trade on options action about that a week ago. Thanks, everybody, for watching. Have a good weekend. Carter?
Yes, thanks for watching. And of course, if you have any questions or comments, be sure to comment or send us a tweet. And if you'd like to be alerted automatically when we post our next video, subscribe and hit the notification bell. Have a great weekend.